Welcome to everyone. Thank you very much for participating and joining in the last panel of this amazing symposium. The rest of the panels have been terrific, and I hope you've had a chance to listen to some of them. In particular, the last one on ensuring equity access to clean energy is, I recommend if you missed it, to see it on recording. And essentially, two of our panelists will be talking about financing, access to financing that helps in relation to clean energy. On this panel, we're focused on financing the innovators and the infrastructure. We'll discuss opportunities to further increase the scale and pace of energy investment through innovative structures and policies, and how to attract capital that also address issues of equity. And this is so critical, as in order to achieve 1.5 degrees Celsius warming limit, we need to find investment in the order of 1.6 to 3.8 trillion dollars every year from now to 2050. Our current rate, however, is only 0.6 trillion. So we are privileged in this panel to have four amazing women who are working in different corners of finance, all trying to address this gap. My name is Jennifer McFarlane, Asterra Partners, and I'm honored to be a new C3E ambassador. I have been raising capital for most of my career, whether as an investment banker or CFO, and the last 10 years have been involved raising capital for clean technologies. And I'm currently on the board of a carbon sequestration company. Today, we'll be addressing four different large financial market segments that are leading investment flows into clean energy. The first is the public market ESG investing. The second, clean energy infrastructure in emerging markets, green banks or funds, and finally, and very importantly, venture capital. In the structure for the session, I will provide a quick overview of these four different financial sectors so you get a sense of how they fit together. Each panelist will then provide a short self-introduction with a few career insights, and we will have a poll for you. And then we'll go through several core questions relating to the panel topic, and with the goal of leaving at least 20 minutes for Q&A. We do want to make it interactive. There is a Q&A prompt at the bottom, so please do add in questions and we'll do our best to answer as many as we can. So starting through those four different financial markets. First, public market ESG investing. In case you didn't know, it is huge and rapidly growing, with about $17 trillion in the US and $30 trillion globally that is now dedicated to ESG investing. And it is resulting in the reallocation of funds away from some traditional sectors, such as oil and gas, into several other sectors, which does include clean energy and infrastructure, and help through the introduction of new instruments such as green bonds. As importantly, investors are also becoming proactive, pushing laggard companies through shareholder resolutions and seeking increased regulation around climate disclosure. For example, the Task Force of Climate-Related Financial Disclosure, a horrible mouthful that ends up being shortened to TCFD. They're exciting shifts. And on our panel today, our ESG investor universe is represented today by State Street Global Advisors, which is the third largest asset management firm in the US with around 3 trillion asset under management. They're also a leader in developing green financial products, having introduced the first green ETF and been an early sponsor of the first green bond fund. We will hear more from our panelist, Natalie Wallace, who has been heading State Street's ESG strategy. The next segment is clean energy infrastructure for emerging markets. Providing clean energy solutions in emerging markets is a win for climate as well as much for equity, with about 1 billion individuals still living without electricity. So the goal of clean energy infrastructure is as much to provide energy for all, as well as to enable faster economic growth by providing businesses with reliable electricity. The demand for capital to support climate smart investments in emerging markets is huge in and of itself, and estimated over $30 trillion. So on our panel today, this sector is represented by the International Finance Corporation, which is helping to actually attract that 30 trillion of capital into emerging markets. IFC, as a member of the World Bank, is the largest global development institution that's focused on catalyzing investments into the private sector in emerging markets. It does this in several ways, including by providing financing to local banks, leading financial innovation to attract large pools of capital, and being a catalytic investor itself into direct investments and funds. IFC has been leading investment in clean energy infrastructure for over 10 years and launched the Green Bond Fund focused on emerging markets about 10 years ago. We have today on our panel Marcene Mitchell to very much thank and appreciate for IFC's leadership role in attracting capital in emerging markets. Our next segment is Green Banks, which is a relatively new type of investment fund and one that plays an essential role in addressing not just climate change, but also, again, equity. A green bank is typically a quasi-public or non-profit organization that marries mission-driven capital with private dollars to rapidly scale energy in underserved areas. Examples include financing energy efficiency for low-income households, resulting in lower energy costs, and supporting community solar, which brings clean energy and jobs to lower-income communities. In the US, there are about 14 green banks have been established at the state and local level, and they are now mobilizing around $1 billion per year. Excitingly, we could be on the verge of having a national climate bank, which is now called Clean Energy Accelerator, that could mobilize up to 1 trillion in total investment. Green bank sector today is represented by the Coalition of Green Capital, a nonprofit whose aim is to support the creation of green banks and green funds. It was established over 10 years ago and has been instrumental in getting green banks off the ground in the US. And we have our panelist, Jill Bunting, who is a leader in the initiatives to thank for this. The final sector is venture capital, which is the engine, obviously, that finances new technologies. In a recent report by PwC on climate finance investment trends, the clean energy segment has attracted about 43 billion of capital in the last 6 years, and it's on a huge roll. About 6 years ago, it was just about $500 million per year. For the last few years, it's totaled 10 billion per year. It's great to see that increase. The sector, interestingly enough, is extremely different from Cleantech 1.0, which was focused on renewable energy. Today, the largest segment is in mobility and transport, which accounts for almost 85% of that total $43 billion invested. In contrast, traditional energy is about 10%, and the newest segment, carbon sequestration, which is absolutely critical, is just breaking on the scene with about 1%. Venture capital sector is represented today by Ajax Strategies, which is backed by a family office. Family offices have played an invaluable role in the venture ecosystem of the past 5 years. With their longer time horizon than the typical VC, say 15 years plus versus 7 years less, they are much better positioned to fund essential hardware technologies working alongside corporate capital. Ajax has made well over 20 investments, and our panelist today, Mila Werner, plays an invaluable role in Ajax in directing investments and, as importantly, in assisting companies to scale her expertise. And this is what it's all about. So now you've got a sense of the 4 sectors we're going to be covering in more detail. I would like to turn to a brief summary of the panelists. You have their full bio available on the web. I encourage you to read it, but here are a few highlights. So Marcene Mitchell, Global Head Business Development of the Climate Business Department of the IFC, leads IFC's investment in emerging economies for sustainable business, and has led the growth of IFC's climate business to $6 billion in 2019. Thanks to her, that is now 30%, it's taking over the IFC, it's now 30% of IFC's total investment last year. In her role, she also creates opportunities by identifying climate change business ideas in emerging markets that can scale. And you can find her as a co-host on the podcast Climate Biz. Our next panelist, Jill Bunting, is Deputy Director Coalition of the Coalition for Green Capital. She has been active in developing the National Climate Bank, now the Federal Clean Energy Accelerator, and has been a leader in launching at least 5 of the green banks at the state level. She previously consulted to large corporations and utilities to develop long-term sustainability plans at the Clean Tech Group. Next, we're privileged to have Natalie Wallace, formerly Global Head of ESG Investment Strategy, State Street Global Advisors. Natalie has just let us know that she's moving on to an exciting new opportunity, but she can't tell us until the new year, so we can't wait to hear. Here she'll talk about her experience with State Street, where she designed specific ESG and climate investment solutions for large clients, working with ESG R&D and investment teams. In a prior role at an organization called Ceres, Natalie worked with institutional asset owners to design and implement ESG integration strategies, as well as a new engagement platform such as Climate Action's 100+. Finally, Milo Werner, partner of Ajax Strategies, and also very importantly, a C3E awardee for her role at Tesla, I believe. She invests in companies commercializing solutions to climate change. She brings to the VC world an extensive operating and scaling experience. And in my humble opinion, there are far too VCs that have that experience. Milo helped build and then led new product introduction at Tesla, as well as has led engineering and new product introduction at several other firms, including Fitbit. So with this introduction, let's launch into the Q&A with the panelists. We're going to start with getting to know them with 2 simple career-related questions and a fun question. So the 2 questions we have are, what was your first position in energy climate change and what attracted it to you? And then what are you doing today in your career that you find most exciting in expanding clean energy? We'll do Milo, then Marcene, and Jill, and then Natalie, and just go around. But before we start, we have a question for the audience as well, a poll question. So we understand your interest in climate and finance and can orientate some of our responses and questions to that. So we can launch the poll, and now over to you, Milo. Thank you. Sorry, I forgot the most important thing. The final question to answer is, if you were an animal, what is your favorite animal? And this I'm just stealing from Emily Kirsch, who does it on her podcast. So thank you very much. Over to you.
Jennifer, thank you. I think my first experience in working in clean tech was at Tesla. I joined while I was at MIT, getting my master's in the Leaders of Global Operations program. I was an unpaid intern. I begged for that job on my hands and knees, and I got it, and it was just so exciting. And I definitely started off in a very lowly position and worked my way up from the ground up. And then my first experience on the investing side, a couple of years after I left Tesla, I went to Khosla Ventures, which is a pretty big venture fund, and worked as the head of operations strategy for their portfolio. Now you want me to tell you what kind of animal I would be if I was an animal?
I would love to, but I'm going to keep it a secret because I think we're going to be running out of time based on a little note that I got. So okay. Sorry, next time. Reprieve. All right, thank you. Now, Marcene.
I've been in the energy business for quite a long time, but I think in terms of clean energy, I was running the Andean region for the IFC based out of Lima, Peru. And had a chance to experience in real time the impact of the melting of the glaciers, where the city and the the people in the Andean region get their water every year from this melting of this glacier ice, and it was not happening at the same level and the same predictability. And you really saw the tensions and the issues that it caused from a development point of view. And I realized then that climate really is a developmental issue. So for a development institution, we recognize that hundreds of millions of people could fall back into poverty if we do not address that climate issue. And so when I came back to the US, I just had to work in this area. And I've been working to try to expand the amount of business that IFC does in terms of its climate, what we call mainstreaming, making sure that climate considerations, moving our clients into low carbon paths, helping them reduce their footprint becomes part of our main business and growing our investments in that. The areas that I find exciting these days, there's so many actually, because I go across the broad reach of what we consider climate business. But I think there's some wonderful opportunities in renewable energy, scaling renewable energy in the developing world, bringing technology such as offshore wind, which we only see now kind of in the parts of the US and in Northern Europe, bringing that to the emerging markets to replace the coal, particularly in Asia. Very exciting. Energy storage, we know we need storage in order to be able to increase the amount of renewable energy we use in each of our markets. And in green buildings, that's the built environment where we're living and working and playing. We need to make sure that those are energy and resource efficient, because we can't just grow ourselves out of this without reducing our energy demand. So there's so many interesting areas and a lot of exciting things that businesses can do to invest in the low carbon economy. I'll stop there.
Thank you. I can tell you're having a difficulty making a choice there. Everything is good.
So good.
Super. So Jill, over to you.
Great. Thanks, Jennifer. So, I was fortunate to know early on that I wanted to work in climate and clean energy, and I wasn't quite sure how that was going to shake out. And my first job was sort of similar to Milo, a very low level role working on federal cap and trade legislation. And I remember I came across this study that was done by the consulting firm McKinsey, which argued that there were an astronomical number of energy efficiency projects, like trillions, that would pay for themselves with energy savings alone, but they weren't getting done. And I just thought that was so interesting that here we were trying to create policy to mobilize investments, and there were good projects that were sitting on the sidelines that weren't happening. And I came to understand that finance was a big part of the reason why that wasn't happening. And I've spent the rest of my career focused on trying to remove those barriers in energy efficiency in other markets. In terms of what I'm excited about, as Jennifer said, science and common sense dictate that we massively need to increase the amount of money going into clean energy. And I'm excited to be a small part of that effort through the network of green banks and clean energy funds we help to develop. And I've been really energized by the work that we've been doing on the federal level to work on the accelerator.
Thank you. So Natalie.
Hey, thank you, Jen, and thank you for having me on this panel with such a roster of esteemed and very competent women. It's really a privilege. I started from, you can hear from my accent, from a little village in France, and I wanted to explore the world. So I spent 1 year in Africa, in a country that was going into its first election. And I was sent to monitor those elections. But more importantly, my drive was I wanted to have an impact. I realized that while I was having fun, I felt that I was close to this impact. I realized that there was a lot of necessary steps, education, capital, finance, and thus my career was really focused on investing in sustainable, in first economic development. And while traveling the world, especially in Asia, to look at opportunities for investment, I realized the impact that capital allocation had on emerging markets, especially around pollution and some building of inequality as the under infrastructure of previous societies were falling apart. So specifically, I will always remember sitting in Beijing, and I had been going to China, maybe 2 or 3 times a year between 1995 and 2003, and actually not able to breathe, right? So pollution was really evident very early on in Beijing. And that was kind of I would say a catalyst for me to say, now let's stop looking at economic development in a simple way and look at sustainable economic development. What excites me is really reallocating this capital, not only because we need it for the planet, for society, but frankly because it's a question of not losing your shirt. We've seen the S&P 500, Exxon actually being booted out and Tesla coming in. This is a clear signal, a market signal that there are some stranded assets out there, valuation impairment, and this has to happen. I think the other part of me, and I won't name the animal I was thinking about, but is I'm a sailor. I strongly believe in the power of the ecosystem and circular economy, because on a sailboat you need to be careful about water, you need to be careful about for food, you need to really live in your environment and understand how the environment can impact you and how you can impact the environment. So this is something that is for me critical, which is how we look at capital and how we allocate it so that we can support the change maker that will have a positive and contribute to the climate transition, but also make sure that we avoid the change takers, the one who are actually not prepared for that transition, because we lose money on behalf of our clients and beneficiaries and retirees. And that's critical for sustainable finance.
Well, I can say, Natalie, is you're doing a fantastic job, since now about 1/3 of assets under management in the US is based on ESG investing themes. Obviously, there are other people who don't lose their shirt.
Absolutely.
But let's now get into the questions. And so we've mentioned about those flows in terms of going into ESG. What does that mean in terms of the impact on clean energy, funding for clean energy, either innovation or infrastructure? How is that making an impact?
And that's so I'll take that question. I think the impact is really related to channeling this capital towards more projects we talked about, but really at the institutional level is avoiding the companies that are not transitioning. And that's why there are several tools that we're using internally to really understand, what a stranded asset would look like. But how can capital impact and really finance the right tools is really one driven by the demands, not only from large public pension plans, but also from the new millennia who are, demonstrated very strong and powerful demand to change the way capital is allocated. I think I want to link that to what institutional investors have experienced with this pandemic, is that there are a lot of companies that are actually not resilient in crisis. And that has really taken a really strong toll on investors who now understand, have a better perspective on the damage to society or systematic risk can have. So investors have come to grasp the risks derived from climate change and climate transition, and also recognize that there are investment opportunities that are scalable. I think that's a real difference compared to 5 years ago, where during the Paris Agreement signing, which exactly 5 years ago, where the scales of projects were potentially not there. Currently, the playing field has really become much wider and much more significant, and thus institutional investors can see how capital allocation can have an impact, not only on preserving the risks they're exposed to, but also reallocating that capital to sectors and segments of the economy that are growing and also delivering results.
Thanks very much. So we'll head over to Marcene in terms of the IFC's played a central role in developing the green bond market, and has also been involved in blended finance. How those two instruments enabled greater flows into emerging markets, and if you can expand on their impacts. Thank you.
Great, thank you. So, as you pointed out, Jennifer, at the beginning, we really need to increase the amount of financing for sustainable investment. We're only doing a third of what we need to do annually. And so one of our big challenges is how do we get people like Natalie to invest more in emerging markets in investments? And so there's some interest there, but do we have the instruments to do that? And so one of the instruments that we find is a good way of bringing in institutional capital is the bond markets. It's something that the institutional capital is very comfortable with. They know this idea, but let's take that to the green bond. So over 10 years ago, about 10 years ago, the multilateral institutions began to develop the green bond market. And actually this year, IFC is celebrating the 10th anniversary of issuing its first green bond. Over these past 10 years, we have issued $10.4 billion worth of green bonds in over 20 currencies, over 221 projects, and that's helped reduce 22 million tons of carbon emissions in the air. And that's an equivalent of something like 2.5 billion gallons of gasoline, if you think about that. So, I mean, it's a great way of bringing in institutional investors to be able to invest in these areas. And we started out with mostly doing renewable energy. That was the first area that institutional investors and others could get comfortable with, and multilateral banks. But it's expanding now. We're looking to see things like green buildings, right? Resource efficiency in buildings is a new area. We're going to see more things in energy storage, electric vehicles, as I think you pointed out in venture capital, Milo, that's a huge area for transport, electric vehicles. So it's a real growth area, and we think that this can be something special. And we're so glad that the multilaterals have been really invested in that and being able to bring capital to the developing world through green bonds.
So I think we get to thank you for introducing actually green bonds to the developed world. Is that right?
To the developing world. I mean, we issue for the developing world.
You did the developing world first.
Yes, but we started there, exactly. So I would say, and I don't have the latest figures, but the green bond market has been doubling almost every year. It's been really expanding. It's an instrument, as I said, that institutional investors, that banks, that other folks really have been interested in. And I see expansion of that into sustainability bonds. We just issued a forest bond. I mean, there are blue bonds now, as well as the green bond. So it has a real foundation here to grow on.
Super, Marcene. If you could just talk to how that investment has actually flowed down to the poorest in terms of making a difference to their lives as well.
Yeah, I think that you mentioned early on about the idea that clean energy is not only an environmental issue, it's an access issue, right? So we started with energy being more like grid-tied energy, but we are developing more things to distributed generation, right? That's solar rooftop. That's how we would think about it here, or mini grids in the developing world. We're seeing the ability of electrification, not just in cars, but also in things like two-wheelers and three-wheelers, scooters and little taxis, which are huge in the developing world, or something that the developed world and the developing world share, electrification of our public transport system, electric buses. So these are things that are going to impact the lives of everyday people. And I just want to say that in this era of COVID and the pandemic, and now we're seeing vaccines, a lot of these vaccines need cold storage, right? And cold storage needs electricity. So this issue of being able to electrify, being able to distribute that electrification to where it's needed most is not only a wonderful thing in terms of turning on lights in your house, but it could be a life-saving technology to help us through this pandemic.
Super. I'll just do a short shout out to one of the poster sessions, which was involving looking at microgrids in Nigeria. So very much on topic. So Jill, if I may move over to you. The Coalition for Green Capital has been around for a decade and has been feeling some seeding and helping the first green banks within the US, how have they been making a difference in terms of addressing issues of equity and the most underserved?
Yeah, sure. So I think this is this conversation is just so timely because I think when you look at the green bank landscape, this is one of the trends that I think we're sort of most excited about. And there's kind of two trends I think I would highlight here in terms of equity and environmental justice. First, it's a process of going through and evaluating and sharpening existing programs and processes. So for example, the Connecticut Green Bank has been a leader in catalyzing solar for their residential market in their state. And they noticed that there was a real disparity, which is not unusual, between solar adoption by high-income households and solar adoption by low-income households. And in response, the Green Bank set out to correct this disparity by focusing on increasing participation from environmental justice communities. And by building that into their process and thinking more strategically about how they deploy their market development resources, they were able to achieve parity in solar lending operations. And by that, I mean households and businesses that receive solar loans from Connecticut Green Bank are representative of the demographic of the state itself. At the same time, we're also seeing green banks designing new programs and really entire green banks focused on issues of equity and environmental justice. In Florida, there's a green bank called SELF, which is creating a program for vulnerable communities. I think this is sort of an interesting example. They're looking at savings on insurance premiums to secure loans for homeowners looking to harden their roofs against hurricanes in vulnerable communities. And this is a huge issue because when the power goes out or when there's damage to those households, it has these cascading effects for the people that live there. And what's not just interesting is sort of how they're tying it to the insurance premium, but how they're also using the roof upgrades as an opportunity to deploy clean energy and energy efficiency upgrades. And the last thing I'll mention is the federal accelerator is designed to have 40% of its investments going specifically to frontline communities. And I'm really looking forward to how having that kind of a mandate continues this progress for financial innovation in green banks and in other types of intermediaries.
That's fabulous. And we'll get more into that when we talk about the National Climate Bank in a moment. So Milo, you are involved in a family office, but there are increasing flows from other sources into venture capital and corporate and private equity. What's driving this?
I think, you know, there has been an enormous amount of capital that's come into the climate change venture community. And it's just been eye-opening. So for the past 5 years, a large portion of the investment has been around based on family offices. And those have been captains of industry who have, you know, brought their firms with them to help champion these investments. Recently, financial institutions have started to become interested in the climate change investing sector. And it's been just amazing to see the passion that comes with that and the struggle that comes with just the underlying factor that software is not going to solve climate change. So many of the financial institutions have really built their names on software solutions. And when they enter the climate space, they have to get real that it's going to be both hardware and software that's going to solve climate change. And just watching them balance out in their own minds and paths on how they're going to financially make those decisions.
Super. So back over to Natalie. Looking forward, what are some of the challenges, opportunities, and that you're facing in terms of increasing ESG momentum and increasing flows into supporting clean energy infrastructure and innovation? What do we need to do to get to our trillions?
To get to the trillions, I think. So we mentioned that we had a lot of opportunities. Thank you, Jill, for mentioning that in the US. I think in emerging markets, we had Marcene also highlights, the not only the needs, but also, the potential growth pathways of infrastructure, building a clean infrastructure for anything related to deliverable, even of vaccines. I think, and I want to relate to the previous panel, which, as you highlighted, Jen, was really fascinating. We have currently, head of investment committee, I would call them, in this large institutional asset owners or asset managers who are really looking at a career risk and looking at, their most of the time annual returns and thus quarterly performance, and thus not thinking, the 15 years maybe that are necessaries in terms of vision, as Milo was saying, of these captain of industries, right, who had a vision for the next 15 years or 20 years or whatever, and we're going to implement that with key results along the way, but also ready to take risks. So I think that's one of the key impediments. And when I'm relating that to the previous panel is that we usually say that, these are old timers, generally with a vision of investment that is based on modern portfolio theory, and diversification is important, but they also not as diverse as they should be from a race perspective, a gender perspective, and a generational perspective. We don't have young kids on the block, smart kids on those. So that's one of the impediments. I think the other big one is, and I would call it knowledge in general of what's going on and the transition our economies are going through. And we can call it an energy transition, societal transition, but these are transitions that are really profound, and we need to be ahead of those and understand how they will impact the money they manage on behalf of their beneficiaries and their fiduciary of these assets. The second thing is, what are the tools that are needed to really understand what are the impact on portfolio valuation, and thus reallocate that capital towards solutions, investment solutions, in this case, clean energy, that really will thrive under a new regime. In this case, I want to introduce the concept of carbon pricing, which is well known, but not yet totally embedded into the tools that investors use to actually assess what's the impairment of my valuation of these companies if I were to put a carbon pricing that reflects the transition, and what are the opportunities that I need to find to be able to reallocate that capital. So I leave it at these two, which is knowledge of the marketplace and career risk, and then having the tools, especially carbon pricing, to be able to forcefully engage in that transition from a financial perspective.
Super. And I think you also had mentioned the importance of TCFD as sort of a step of providing disclosure.
Yeah, disclosure is key, and we had this discussion, in many fora. This is important. Having disclosure of climate risk is important. I think the next step beyond disclosure is managing based on this data. I think that's what I'm referring to, having carbon pricing. So having this information, yes, companies disclose, investors disclose. What do you do with this information? And how does this data really drive your investment decision and change the allocation? And so I'm looking at the performance related to that information that is disclosed. So I think that's the next step that we really need to get into.
Because the implications of using $20 versus 50 versus 100 is tremendous.
It changes your CapEx allocation or your investment into green bonds versus brown bonds. Clear, that's it. That's a very, very clear market signal.
Great. So Marcene, if I can go back to you, what are some of the near-term catalysts that you see bringing additional funds into emerging markets to address climate change and to provide access to clean energy?
Right. Well, I absolutely agree with Natalie that the idea of a price on carbon would make a huge difference, right? Because, what businesses want, I mean, obviously they don't want more costs, but more importantly, they want a predictable, stable regulatory environment. They want to know what, things are going to cost, and then they can react to that over time. So I think that would help, as Natalie said, really drive asset allocation and capital allocation over time. So that would be my number one. But number two, and particularly in emerging markets, is the issue of risk, right? I mean, one of the things that stops capital from flowing is the idea of not having a balanced risk reward. And remember, when you do in emerging markets, not only is an investor taking the technology risk, it might be a new technology like energy storage, a more known technology like renewable energy, or something even completely new like hydrogen or nature-based solutions, right? These are things that are not known, so they're that risk. And then on top of it, you're putting a country risk, you're putting emerging market risk, you're putting currency risk. So how we kind of, back out these risks are going to be really important to let capital flow, and who's the right institution to take, which risks. So sometimes we talk about blended finance in my world, right? And that's where governments are coming in to take on some of those risks, so that can open up the door for private capital to flow. Some of that risk may be just buying down interest rates, right? So that it makes it more affordable. Some of it might be to guarantee loss reserves, right? So that if there's a loss, the private sector doesn't bear the entire burden. Some of it is performance guarantees on, infrastructure that the government is actually going to buy that power that you're producing. So really understanding what these risks are in these different segments and who can best take on those risks in order to allow capital to flow. So that's what I would say is really where innovation is needed, really where focus is needed, really where a little courage is needed to get in there and allow those investments to flow.
And are you seeing who are the candidates who understand that risk, who are starting to step up?
Right. So, I mean, part of what Jillian's talking about in the US is this idea of a green bank. That's something what a green bank does. It's bringing the private, the public sector to work in conjunction with the private sector to bring these flows in. So definitely governments are part of that. Multilateral institutions like where I work are a big part of that. We really understand these risks. We understand how to take these risks. We're very good at evaluating credit and evaluating risk. We understand our countries, at least in the emerging markets. So we are a big part of that. And then government, the governments and the private sector. Private sector more and more, as they're making these pledges to become, we're all trying to move towards zero carbon by 2050. I think that's going to be the new mantra. That's the new goal. And as governments, as companies are making those pledges, they need ways to invest to reduce their footprints. So they are looking to do that, and they're looking to their financial institutions who are used to lending to them, for example, for a building. Now they need to lend to them for a green building, right? So it's really the entire ecosystem. Everybody has a role to play, and it's just making sure that the right people are taking the right pieces of that pie and the right risks, so that all that capital can move forward into these areas.
And I want to jump in very quickly, because I know we're talking about US technology and investment, but there is an additional, and I want to really focus on the fact that major Asian countries, especially China, are taking investment in climate transition. So, from new technology, from a clean perspective, clean and renewable, but also from a business disruption perspective, right? What does this mean for other businesses? They're taking this very seriously. And this is where the next country macro competitive advantage come through, right? And this is really important for US companies, US government, US infrastructure or green banks. This is very important for a country to build the competitive advantage for the next 100 years, because it will allow its population and society to actually thrive in the new climate environment. So it is seen as a crucial investment, and thus we're seeing actually local investors, and correct me if I'm wrong, Marcy, local investors actually stepping in and starting to become much more involved compared to my years a while back when I was a bit younger. And that's, I think, a major change, is that local governments are actually really pushing for these kind of investments.
Super. Well, yes, the bang for the buck in emerging markets is huge in terms of jobs, business, increased business, new industries to be competitive at. So that's it certainly makes sense. There's a question that came through in terms of on the chat, and I'll just use it to sort of, in case it's adding on, it sort of said, to what extent is government regulation needed to accelerate investment to achieve carbon emission to get carbon emissions reduced by 50% by 2030? I think we've already talked about carbon pricing, but is there anything else that comes to mind as a key must have?
Yeah, I could weigh in on this one.
Thank you.
We're seeing a lot of investment opportunities in commodities, such as cement, plastics, just a lot of innovation there into clean building systems. And these systems, when they start out, are not cost effective because they're not at scale. It's almost impossible for clean cement to be competitive with traditional cement when it's at one small factory, when there's just a massive ecosystem industry out there competing with it. And so the government regulations are just incredibly important to allowing those startups that are producing these materials to get a foot in to become competitive. So yes, there does need to be government regulation. And a lot of it's at the state level in the United States, even at the city level.
Yeah, and I would just follow up with that I think regulation is critical, and also government investment can be critical as well, whether you're talking about investing in early stage companies to help prime the pump for something for commercialization, or if you're talking about technologies that are about to get to deployment. It's interesting when we talk about green banks or clean energy more broadly, this is not a Democrat versus Republican issue. This is an issue of broad bipartisan agreement. And in the work that we've done, we've seen green banks be a source of bipartisan agreement and signed into law by Republican governors in states like Nevada and supported in states like Michigan. And I think, as we're looking towards how we're actually going to move forward with this and how we can get the most buy-in possible from elected officials and from a coalition of folks, it's, I think, talking positively about not just what kind of regulation we can bring, but also what kind of investment we can bring from the public sector.
I want to reiterate the point I was making before. If a country wants to drive and maintain and lead in terms of competitive advantage, yes. So regulation in the form of subsidy, again, a carbon market, but that are necessary, right? Again, to keep being a leader in that space and a change maker, not a change taker. The second thing I want to say is if the emissions continue on the path they are today, meaning, the worse it gets, the more inevitable regulations are. And they can be costly rather than supportive. Again, that's a message I want to send to companies and investors out there, is that it will happen, and thus you'd better be on the forefront of that. And use, advocate for regulation that are supportive of innovation rather than preempting potentially development for companies that are too big to change, and thus we have a large potentially tax imposed on them because they couldn't change.
Thank you, Nelly. So Thank you very much, Milo, for that comment. I mean, basically, the success of solar, the success of Tesla, of the mobility transport, is really due to government involvement, like full
Yeah,
stop.
huge government support.
Yeah.
Yes, there's huge government support when Tesla turned the corner.
And so this is a great time to go back to Gillian and talk about what was originally called the National Green Bank, and now in terms of, I guess, positioning for supporting innovation, is now called the Federal Clean Energy Accelerator, which perhaps we may have, with bipartisan support, some hope for in the new year. So can you tell us a little bit more about it and how it could make a difference in terms of innovation and infrastructure?
Yeah, sure. So the accelerator is a concept where Congress would make a one-time appropriation to a federal entity that would provide startup and investment capital for green banks and other sort of related clean energy funds. And again, these institutions exist to sort of do the work that I think we've been talking about in this panel, which is how do you connect the projects on the ground to these big pools of capital, these institutional pools of capital that are trying to get in but need the right pipelines to be built. And that's sort of the role of these institutions in the market. And, you know, I think it's interesting because the political climate in the US is, we're at a unique moment right now. And we've talked to a lot of folks about whether something like this or anything around climate can really move forward. And as we were saying earlier, I really do feel optimistic that this could move forward because of the bipartisan nature of clean energy. I think that's sort of what's happening on the ground. In terms of what's going on in DC, the support for the accelerators really was huge going into the election. The House bill was led by Representative Debbie Dingell, and it passed twice in 2020. And that called for a $35 billion appropriation to the accelerator. And again, that bill passed twice in just 2 times in the last 6 months. And in the Senate, Vice President-elect Harris, along with other leaders, were co-sponsors of the companion legislation. And so as the nation thinks about how we're going to face the recovery coming out of COVID, we think there is a very good chance for something like this to move forward in an economic stimulus package in 2021. Oh, Jennifer, you're on mute.
Thank you. Is it going to be supporting more innovation, do you think, based on its name? And we need more than that.
Yeah, so I think the way I would frame it is it's going to do more of what's already working on the ground, and that's deploying proven technologies. So we're going to see more flows into things like energy efficiency for residential buildings, small and medium-sized solar arrays, community solar. These are sort of proven things that have worked in certain green bank markets and can be expanded to all 50 states. In addition to that, because the money will be more flexible and coming from a centralized source, I do think there's this opportunity to sort of move into markets that haven't really been reached by green bank tools, things like energy storage, microgrids, clean transportation. These are all things that I think the green banks that we work with would love to develop products for, but they haven't had quite the resources and pool of capital available. And having something like this at the federal level will sort of unleash their creativity in thinking about the kinds of innovations that would work in those markets.
Thank you. So I'm going to go to a couple of questions in the chat. I'll mention 2 because I think they're some are a bit more specific. One is, how does energy resilience in the face of climate influence investment? And maybe, Natalie, that's a good one for you.
I can chime in on that one too, Natalie, when you're done.
And please do.
Okay,
Go ahead.
first. I would say that it's a huge piece that we've been thinking about. I'm based out in California, and basically there's been an immense amount of power outages throughout California, multiple week-long power outages. We're on our 3rd year. So many people are going out and buying backup generators that are either powered by natural gas or diesel. And on the climate investing side, we've been really thinking hard about how can we provide backup power access to both businesses and residents that does not involve fossil fuels. And so I would say there's just been an immense amount of work going on with that. I would also say that, and a shout out to Generac, whose stock has doubled in the past year because of all the demand. They have been working hand in hand with the venture capitalist community to help figure out how they can support this backup energy needs outside of the fossil fuel industry.
Right. And just let me jump in there. Obviously, that's a clear issue also in the emerging markets, right? The whole use of diesel generation, not necessarily because of, disasters, but just because of weak grids. Also, it's spending a lot of fossil fuels on those type of backups. So being able to move those to clean energy is important. And then again, in emerging markets, this idea of resilience and energy resilience is a key one, because we're going to see a lot of these climate impacts, disproportionately hitting the tropical areas, the hotter areas. And we need to start thinking about resilience and what that looks like. And not have the mindset, if we start thinking about resilience, then we're going to forget about mitigation. We obviously need to do both, but resilience is important. And which brings us to kind of nature-based solutions, which is kind of a combination of being able to use nature for both mitigation, meaning being able to absorb carbon, but also for resilience. So addressing things like sea level rise with the increase in mangrove plantings, or using green roofs or shading or trees in urban areas to reduce hot spots. That type of resilience is really going to be important. And I think that we're going to start seeing much more investments coming in, not just on mitigation, but on this idea of resilience, as we see more and more, physical climate impacts across the globe.
And
I would just quickly add very quickly that PG&E was the first bankruptcy due to climate change. And highlighted the lack of investment in infrastructure that is still, blatantly obvious today. Going back to one of the most advanced economy in the world, if not the most advanced state in terms of innovation, having to deal with infrastructure related and as simple as, in the developed world, accessing electricity cheaply without interruption is a very new investment trend, I would say, for large institutional investors. It's really all of these elements, I would say more importantly than even the Paris Agreement, really drove the attention towards the issues, and really switch, again, the understanding that you need to look at climate risks. What does this mean? It's transition risk, not only physical risks. What does this mean for my portfolio, and how can I actually take advantage of the new emerging trends where I can allocate the capital so that I can, again, avoid participating in the economic development here of California in this case, but also avoid being in stranded assets that are actually not viable in this new decade of economic development.
I was on a panel on Monday with a woman with San Francisco Airport. Basically said they're building a 10-foot wall to give them security or protection against 3-foot sea level rise. I think that there's a bunch of caveats. It's sort of once in 100 years, and what does that mean? But I think that, to me, is a really good just sort of like data point that says how impactful this can be in terms of stranded assets. Thank you. I'm going to just check, is there anybody else who wants to go to that question, or I can move on to others? We've actually got, I think, about 2 minutes left, and we've got about 10 questions. One of which was, how can we make the US DOE loan guarantee program for clean energy projects be improved? And Milo, I don't know if you've looked at that, or others have looked at that.
Yeah, I think I haven't looked at it. I don't want to talk to it. I haven't looked at it super closely. I mean, we have had some interactions with it, but I would say if anybody else wants to weigh in on it, go for it.
Okay.
Well, I think I would just say I think this is asking about the LPO, Loan Program Office. But in general, one thing that I think is just challenging about a lot of the federal programs is that they can be challenging to work with. Like the diligence process for getting them is tough, and they are kind of overly specific. So I think one thing that I would love to see at some of the federal levels is a little bit of a broader approach to some of the technology areas that they look at. A lot of them are carved out for just specific clean energy technologies, and as we've talked about in this call, we need programs that address resiliency and buildings and infrastructure. And I think adding that kind of broader lens to some of these programs will be helpful to increasing the number of applicants and actually getting those dollars out the door.
Super. I believe we're at 4:20, and I believe the hour has passed unbelievably quickly. And I want to thank all of you panelists for joining us in a conversation that could go on for hours. And I also want to thank everybody in the audience for hanging in for this last panel on finance and clearly allocating more money, increasing the flows to trillions per year versus under trillions per year is important. So each of these panelists are playing a role in that. And we can give them a virtual round of applause for their role and for participating on this panel. So thank you very much, and I'll just do this.